Hello, ladies and gentlemen, a warm welcome to today's webinar, which is brought to you by Shared Services Link in association with Blackline. Today we're talking about the future of finance evolution for global business services. My name is Susie West. I'm the founder and CEO at Shared Services Link, and I'm delighted to be introducing Tom Bangerman, who is GBS Shared Services consultant at Conaxia, and Danny Wheeler, who is AR Solutions Strategy Manager at Blackline. So great to have Tom and Danny with us today. Do make sure you make most of your time over the next hour and send me your questions. So there's going to be a lot of data coming your way, a lot of insight, a lot of comments that will stimulate some exciting thoughts. So any questions that bubble up, pop them through to me on the GoToWebinar text box, and I'll put those through to Tom and Danny in the last few minutes of this webinar. So we work in the world of shared services, and maybe some of you on the call are thinking about shared services, GBS, maybe taking your finance shared services into a more of a broader functional global business services organization. But wherever you are in your journey, there are so many internal and external pressures and influences occurring. So there's challenges really coming at us from each and every direction. What we're going to be doing today is really walking you through some insights that might help you navigate some of these changes that are being experienced currently, and we're anticipating that we will be experiencing over the next kind of 12-18 months. And really zeroing in on the finance function, and within the finance function, we're then going to be paying special attention to the accounts receivable and order to cash processes as well. So let's kick off and start focusing on some of the trends within finance and GBS and shared services. Talk about the best practices for optimizing your accounts receivable and order to cash process, and some tips as well to stay competitive. So straight over to Tom. Over to you, please, Tom.
Yeah, thanks, Susie. So in terms of agenda, we're obviously going to do this together, Danny and me, and share some insights on the GBS or shared services overview or trends, and then in most of these areas focus on what does that mean for accounts receivable or order to cash, whatever you call that. I picked some topics. This is not covering all the topics you could potentially cover, but we can't do everything in an hour. But these are some of the things I found very interesting in all the different research that I've been doing the last 12 months. So in terms of just general GBS setup, now obviously most people here are finance, at least I'm assuming so. And that is most of the GBS that exists, because while there are some functional GBS setups, for example, HR, most GBS nowadays, or shared service organizations, however you want to call it, are multifunctional, typically about 2/3, 3/4, depending on how you measure. So order to cash or accounts receivable within that should actually be included in almost everybody's operations today. And then this is an overview of different processes, sort of the scope coverage of existing GBS. And I know it's really a lot of small print on it, and we don't need to go through the whole list, obviously. What I wanted to point out here is a few things. One, transactional finance processes like OTC or PTP obviously are always on top of these lists. And here they are shown at 69 or 66%, which, considering that most are multifunctional, and then you have a few finance shared services on top of that, most people will operate some part of these processes in their operations or in their shared service organization. What is also interesting is that there's things that increase a lot, especially procurement and supply chain processes, sort of in the middle of this slide. They have the highest increase percentages, so they will probably move up on this list fairly quickly. And then do not disregard things that are on the bottom of these kind of slides. What I see people do is they sort of draw a line in the middle and they look at the upper half and just ignore the rest. That might not be a good idea, because there are things like, for example, ESG on this list, which is only at 9%. But as you will probably know, ESG becomes mandatory in the European Union in terms of a special reporting requirement in 2023. That's this year, in case you didn't know. That means at the end of the year, we need to be producing reports on this topic, and it touches approximately 50,000 organizations. So the size requirements are very small, so most of us will have to do something. And this could be a really good topic for GBS to cover, at least cover parts of it. And then there are other things on this that could be sector specific. So for example, if you look at things like health and safety, so if you're a company in, say, oil, gas, chemical, or any industry of that sort, then health and safety will be absolutely mandatory and a huge topic for you. And in most of those organizations, some parts of it are supported by GBS. So for those sectors, it's a standard process that is very high up on the list, and others will maybe not just do anything on this topic because it doesn't apply to them, right? So there might be things on the list with smaller percentages that are still worth having a look at. And then in every single piece of research that I tend to do, I look at two things. One is maturity and one is automation level. And you can, of course, do a very complicated measurement on maturity, but this is sort of the self-reflection question. So if you just ask people to select where they think they are, low, medium, high, or expert, and considering that we've been running shared services, GBS kind of organizations for over 30 years now, you could look at this slide and think that this is not a very good result, is it? Because there's only 29% which are high or expert. On the other hand, of course, there are still organizations today that start on the shared service journey. So it could also be a testament of the concept being very successful and being expanded all the time. And then if you look at automation levels, similar kind of question, we see that only 18% are high or expert. So typically on the automation question, you get slightly lower percentages than on the maturity one, which I think has to do with the fact that maturity in different geographies is seen very differently. So if I ask this question, for example, in the UK, typically maturity means age, but of course, it doesn't have to be age only. It could also be things like scope, how much are you covering? It could be the productivity or cost level or performance level in general that you perceive your operation to have. And all of that sort of mixed up could then produce a maturity level. So therefore, automation level itself, being a bit clearer in definition, often ends up with lower percentages. And again, for a 30+ year journey, this is not very high. And obviously, Danny is on the webinar today because he's the automation expert and hopefully can give us a few tips on that. So with that, I'll give it to Susie for poll question number 1.
That's great. Thanks so much, Tom. So coming up on your screen now, please just tick one of the boxes that applies. What is your top strategic focus today? Is it cost stroke efficiency? Are you striving pretty much exclusively for service excellence as your top strategic focus? Is it the provision of value, effectiveness, or something else as a top strategic focus? So maybe customer satisfaction, agility, risk reduction, compliance, etc. We'll wait for a couple more responses to come in. Closing the poll in 3, 2, 1. Let's have a look at the results. Thank you. We came in at 69% of you responding there. So the winner there really just under 40% is cost stroke efficiency, followed by service excellence coming in at 30%, effectiveness at 13%, followed by value, and then other. Back to you, please, Tom.
Yeah, that is really great, because you can see if you compare what you just answered to the results from the sort of overall market, it is basically the same order of priorities. So we have cost on top of this. A lot of organizations would like to discuss something else than cost. They're not very happy about this constant cost focus, but it is quite typical for a time like ours now, because we're in this famous VUCA world and there's a crisis going on all the time, and therefore whenever there are crises going on and people are a bit insecure, then they typically focus on cost a bit more. And it is also very wise to look at cost when you are expecting a potential recession, because you do need to prepare for these things. It's just proper behavior from a management level that is expected. So even if the recession doesn't come, they are sort of required to do preparatory measures. So therefore, not surprisingly, cost is up on the list. We like to discuss value more than cost, but it's only at 36%. What I find interesting is that customers are still at 34%, because everything we do in shared services is really about the customer. I mean, it is a customer-facing activity, and a model like this cannot be successful in the long term if it doesn't consider what the customer wants and make him happy. So I would expect that to be slightly higher in the future. And then agility is something that at least I have been preaching for 5 years now at least, trying to remind people of the fact that this is not about you being able or available 24 hours a day, but it is organizational agility, which means that you can always respond to changes, either internal or external changes or change requirements, whether it's a pandemic, a crisis, supply chain issues, or whatever it is, difficult labor markets, all the things we're facing. So I think agility should be higher, because I would rate that as very, very high in relevance.
And then ultimately, this is where we're seeing businesses kind of move towards technology to help them look at everything that was just on Tom's list before, as well as kind of activities that happen in the business just by virtue of the business as shared service existing, all the things that kind of keep the day-to-day running as well. So the biggest one is working capital. Ultimately, businesses kind of ever more focused on efficient collections and applications from an AR perspective to enable them to collect on outstanding debt, get more money into the business to keep to pay for operational costs. Ultimately, with the knock-on of preventing them needing to borrow, which at the minute with higher interest rates comes with that higher cost of borrowing money. Then additionally, engaging staff, engaging people within the business. People want to be challenged. They don't want to just be a cog in the machine. They want to work for businesses that are seen to be progressing, transforming, and allowing them the chance to apply their learnings and their intelligence to work in a forward-moving environment. They don't want to be stuck doing data entry, the manual processing day in, day out, or ultimately, they'll look to be engaged somewhere else and they'll leave. And ultimately, you don't just lose the knowledge that walks out the door with them, but then, with the way things are with the labor market, there's the cost and the effort of going through that process of hiring a replacement, which is becoming harder to do. Then additionally, everything around data control, how it's processed, how it's stored is a big challenge, a big problem, all for the right reasons. But any element of risk or insecurity around the process is going to cause issues. So businesses are using technology to enable them to solve that problem, reduce the human control element of data sharing and data transfer, and just shore up all their processes that sit within the business. And then something on this slide that Tom just mentioned on the slide before around the customer experience. For me, from what I've seen in working with customers, there's twofold to this. There's the internal customer and the different business teams that are working together, and then the external customer, the person taking the product or the service. And ultimately, to give the external customer a better experience, internal customer teams need to have a better experience too. And we're finding that with technology, we can reduce the siloed element of teams working together to make the process more cohesive, which in turn means a slicker, more efficient process, which benefits those internal teams that then impacts the external teams. And so it's always worth looking at those two elements kind of when you're considering actually what does customer experience mean. If we take AR as an example of what we'll come on to in a minute, there's always been siloed natures there between payment application and collections teams and how one side impacts the other without any way to improve. And that's something that we're going to look at in the next section with Tom as to how that can be improved and worked on. And so that's what we're going to look at in section 2.
Okay, and then if we look at the order to cash process in terms of sort of sub-processes or activities within it, we saw already in the overview that order to cash in general is covered by most companies in their GBS organization, but we can of course dissect this by sub-process, and we'll see that typically the end of the process activities, or accounts receivable or invoice to cash, if you want to call it that way, is done in GBS, and then some of the order management and some of the sales and quote management is still outside for some companies. But most likely that is going to, whoops, that was one too many, that is going to change. So you see here the same slide, and it just says planning on the top. So that's what people tell us they are planning to do. So all of these will increase. So in sum, order to cash is a very typical GBS process, and in the near future, probably most of it will be done out of a GBS environment. So with that said, Susie, to you for poll question 2.
Thank you, Tom. So coming up on your screen, second poll question, as Tom mentioned, what is your level of automation maturity today? So you've got quite a few options here. Would you say it's low? No process management, we are just getting started. Medium, we're inspecting sub-processes but do not have an end-to-end view. Advanced, we have implemented end-to-end process management. Or expert, tangible benefits from closed loop feedback from end to end. So what is your level of automation maturity today? We're at about 51% of you responding. If you haven't already responded, please do so. Closing the poll in 3, 2, 1. Let's have a look at the results. 63% of you responding. So thank you for that. So yeah, winner here, that's 67%. Medium, inspecting sub-processes but do not have an end-to-end view. No one in the expert category just yet, but 20% of you saying that you're in the advanced category. So interesting. Back to you, please, Tom.
Okay, thank you. So 0 experts might have to do with the fact that the audience today is just very humble and doesn't want to tick that box. So that's great if that's the reason. But in reality, as we see also on this slide on the top, if you look at order to cash assumed maturity, it is the same kind of distribution. So most people are either in low or medium. It varies a little bit depending on which process and who we ask. Again, I'm not criticizing this in any way, but if we work on the process for 30+ years, we might expect it to be somewhat higher. And I know that many companies are somewhat frustrated about the fact that it's quite difficult to get to very high automation or maturity levels. And one of the reasons could be that the environment's changing. So if you are working constantly to increase your maturity or increase your automation level, but the environment changes and there's new requirements, so you have to respond to those, then of course even staying at the same automation level can already be an achievement in some ways, because there's work required to just keep the same metrics. So therefore maybe these metrics aren't as bad as they might seem initially. And then just a few more metrics. I know that people like metrics, and so I'll share a few. Specifically for order to cash, what percentage of customer orders are received electronically? Again, this is a fairly standard activity, but we're still not very high. Some people are able to get over 80%, but you can see that sort of half the market is above 50% and half the market's below. So there's certainly more potential there. Automatically generated e-invoices is an easier question, because there we have 60% or so already over 80%, but there's still a significant amount of the market who hasn't tackled this one. And then what is the percentage of invoices related to disputes? The average there would be somewhere around 3 to 4%. And then if you look at the one right of it, what is the percentage of customer invoices corrected for billing errors? The average is at 2 to 3%. So if you take those together, it probably means that most disputes are actually generated by yourselves in terms of errors made in the process, and not just because the customer is difficult, right? Automatic remittance posting varies a lot depending on region, we know that. And then time to bill, of course, could be significantly faster. So only about half the companies are 2 to 3 days or better. So that's sort of the timeline that we normally would think is acceptable. So the upper half has a bit of potential left.
Cheers, Tom. And I guess, taking some of the points that Tom mentioned there around where automation's heading and where people are looking at, a lot of the things that people are doing in silo will naturally improve that process. So, Tom mentioned about electronic invoice processing, which naturally improves one element of the process in terms of, invoice to cash, for example. But the key with any of these changes is actually not just benefiting one single process, but actually what it can do to give you an insight into the process as a whole. So, for example, e-invoicing is a great way to capture additional data and learning around an understanding of what your customer's doing, how they're working with you, have they opened the invoice that you've sent to them, have they made payment for it, have they queried it? And ultimately all that data that comes in is okay if you've got the time to do something with it, but a lot of the teams that we work with, a lot of the businesses are kind of doing the best or the most with the team they've got. And ultimately we think that the only way to make use of that visibility is through the automation, because ultimately that's the piece that's going to take the work away, the data entry piece, the time that's taking the teams away from being able to do more with the data in the process and to make effective changes. So if we look at kind of the first step of that, if you like, and this goes back to the point I made, around AR teams and how traditionally they work in a siloed manner, but with technology and digital platforms, you can improve those processes singularly. So each of the different areas gets improved, but you can then also impact the wider business, as I was saying. So now, you can automate the process, but you can start to layer in extra data from a collections process, to help you define the customers that you need to target or the ones you need to chase, or, build a picture of how actions in the collections process impact payment from the customer. So is it that you've called them twice, sent them a letter, but actually it's the letter that generated the payment? And because you're sharing that data back and forth from the different modules, you can start to build that picture and have the system build that analysis for you. Examples that we've seen with customers is they'll create promise to pay on the collection side, but actually that in itself becomes useful allocation data or application data once the payment comes in. And when the payment does come in, if it comes in, there's a few actions that typically would be manually driven, but with automation, you can just remove those extra steps and give teams that time back. So in the example of the promise to pay, you don't have the collections person, the collections team going back, checking the bank statement every day, talking to the cash application team to see if that payment's come in, is it in the queue, is it going to get applied? The system is going to do that for you. It's either going to automate the payment itself because you've got that data already, or the system can use the machine learning to do that, or and close off the activity in the collection side of things. Or if it doesn't, the invoice is still going to be outstanding and that activity or the promise to pay is going to be open. Therefore, you can automate that to come back into the collector's workflow to say, look, you've created this promise to pay and the payment hasn't been opened. So while automation is great for improving communication between teams, actually a lot of that communication happens automatically in the background just by virtue of those platforms sharing data, sharing visibility into that process as well. And then, on the screen, I already mentioned e-invoicing as a part of that process now, in terms of seeing the gap or the black hole, if you like, of the invoice gets generated, but then, you don't, from a collections point of view, you're not really kind of looking at it until it's about to come due, or it's overdue, or there's a payment for it. Now you can start to look at that process even earlier to automate that and get the efficiencies in terms of, we've sent it via email, has it been received? Have they clicked the link and opened the invoice? Have they made payments? Because chances are if you've sent an invoice and 4 or 5 days later that email hasn't even been opened, it's unlikely you're going to get paid for it on time. And so you can start to really kind of put that data back and forth, build a picture of what that looks like. But then what you can start to do once you've got that operational efficiency is build that out to build better experiences for essentially the customers that you're dealing with, because you're not chasing them for invoices that are still outstanding because the payment's in the queue, their accounts aren't going on stop because you haven't processed that payment soon enough, all of those different things that mean they're more likely to come and work with you in the future. But also then you can lift that strategic data out to feed into back-end finance teams and the sales teams. And just kind of a couple of examples of what we mean by that, from the sales perspective, AR is traditionally seen as sales prevention. We don't want to deal with this customer, we don't want to deal with this, but now you've got that data to explain why you don't want to deal with that customer. And actually on the flip side, you can start to identify an ideal customer profile and actually say, we want to go and deal with these customers more. Or of your existing customers, you can identify good payers, frequent payers, extend credit limits with them to do more work with them, knowing that they're good payers, but also with the security that the system is sat there monitoring all that data, that if they do change and start paying later, you can start to be more proactive. So you can look at what makes a good customer, who should you do more trade with, who actually costs you to do business with. So going back to the working capital point I made earlier, if customers are constantly paying you late, that's a gap that you need to go and fill. So therefore, you're going to have to borrow the money to fill that, and therefore you're going to get impacted by that cost. Actually, if that's a consistent thing, you may decide that you don't want to deal with them anymore, but to go and work with customers that do pay you on time. In a traditional manual process, especially in a shared services process where these things are global in multiple locations, which we'll come on to, getting that visibility of data in a time that makes it usable before the world moves on isn't going to happen. But with automation, you can do that, and then you can put your teams to work and really kind of looking at what's going to move the business forward. And then at the back end, as I said, you've got the system sat there looking at the risk, monitoring it, who pays, how much do they pay, how often are they paying, building better visibility into that data to give you better payment predictions, therefore more stronger cash flow forecasts, because you're seeing how customers are actually paying you, not how they should be paying you based on set terms and building from there. That's ultimately going to give you the ability to ensure greater financial stability, and as I say about the forecasting piece there. So really what you start to do is lift AR from a back office function of just processing data, just by automating that process to become more of a strategic partner in the business as well. I mentioned there about locations and how technology can help that. Tom's just going to go through a few stats first around what we've got from the data in terms of the location side of things as well.
Okay, I've got a poll question, and then I'm going to hand over to Tom. So yeah, just before we jump into a bit more detail around locations, let's find out how many locations you operate in. So do you operate within 1 to 2 locations, 3 to 4 locations, 5 to 6, 7 to 8, or 9 or more? So if you could just let us know about your location setup. Do you operate in 1 to 2 locations, 2 to 3, 5 to 6, 7 to 8, or more than 9? 9 or more. Closing the pot in 3, 2, 1. Let's have a look at the results. And we can see here that actually the largest group here, 38% of you, operate across or within 9 or more locations. So over to you, please, Tom.
And this would be the comparison now to the overall market. It's actually not completely different, not surprisingly. On this one, you will also see that sort of from 1 to 6, it's about 3/4 of everybody. So we had a little bit more locations in this group than on market average, but nevertheless, the picture is still kind of surprising in some ways, because everybody's trying to consolidate activities into sort of a handful of centers. And the logic always was one based on this regional model where you had a center for the Americas and one for Europe and one for Asia, and then you potentially needed specific centers for a specific reason, like China for China or Russia for Russia, or you needed 2 in the Americas because Brazil needed a separate one based on 64 different tax variations and so on. So, you know, historically we know how these things have come about, but the logic was always the basic follow the sun logic of 3 times 8 hours equals 24, and let's try to do it somehow on that geographic basis. So not surprisingly, you end up with something between 1 and 6 typically. The fact that some people can do it from 1 actually is kind of surprising. I would assume they're not fully global, otherwise it's really a stretch. But 3 to 4 was something that many aimed for. What is the most interesting thing out of this location research piece that I did some months ago, and why I included this in this webinar, is that there seems to be a change in the trend. So while we were trying to reduce the number of locations for many, many years, there now seems to be the opposite trend. There's more a desire to, let's say, increase the footprint or reduce the risk by not putting all eggs in one basket. And also you could say people are trying to utilize more and different labor markets or get access to different labor markets. So a range of reasons why more locations might make more sense than less locations. And I've done loads of location work in the last 2 years for different clients who did not want to move anything away from where they were. They just wanted to open up an additional location. And sometimes it could be skill or capability based, so that, for example, they move up the value chain and require different skills than those that they required previously, and feel that they're not available in the location they're in today. So it could be all of these reasons, and they're all good reasons. But that's why I thought it makes sense to highlight the development on the location front. And then what I did with those numbers that you saw just previously, I sort of correlated them with the automation level, if you still remember that from 15 minutes ago. And interestingly, got a very, very nice correlation here. So without becoming too academic here, but what you can see is that companies on the left who have low automation typically have between 1 and 6 locations. And on the right, you can see that those few who were expert all have 10 or more locations. I mean, all. So it's a very clear correlation. And when you look at it, you would, I think, initially think that this doesn't make any sense whatsoever, does it? Because aren't we expecting those companies that are really good at automating to also be very mature and have done everything else that you typically do in GBS and have consolidated and standardized into very few locations? But obviously it's not the case. And I think the answer that most people probably, because you all deal with shared services and GBS, will know anyway, is that if you think about how we used to set up GBS organizations, most people followed some sort of lift and shift type approach. And then we took all the work and consolidated it into a few centers and then transformed. So most people did lift and shift and transform, or some version thereof with your own sort of wording variation. And that means that initially people consolidate and standardize and use the labor arbitrage, but they're still in, they are not automating yet too much, but they are already in fewer locations. So that's the left side of this picture. And then there are companies who, for some reason, cannot consolidate that much. Could be political reasons, historical reasons, whatever. They're always very good, but they're very company specific. So they have to do everything else they can. They have to pull every single best practice that is available to somehow get all the benefits from the productivity side, because the labor arbitrage side is not going to bring that much. And therefore, at the end of the day, it's actually quite logical that people who don't have the labor arbitrage available must do more work on the productivity side and therefore end up being real experts in automation. Hopefully, you would end up in sort of the combination of these two things at some point in time. So I also think this is sort of a picture of a journey at a certain point in time, and we're somewhere in the middle of this journey, and the left and the right side will probably merge over a period of years. And then in terms of locations, again, we looked at different dimensions that you could rank locations by, and there are several dimensions. This is just an example. And this is not a cost comparison of these regions based on real data. The question here was different. It was, what is your perception of these regions in terms of cost, or whatever the dimension was? It could have been workforce availability or availability of digital skills or productivity or anything else, but this is just a cost example. And as you know, perception is truth to some extent because people behave accordingly. So not surprisingly, India is on the top of this list. Latin America obviously is perceived to be very cost competitive. Whether that's true or not is a different question, as I said, but is perceived to be very competitive. And I realize it's a very large region, so what applies to Chile does not necessarily need to apply to El Salvador in the same way, but it is just a directional answer. And obviously the right columns, the three right columns, are not really delivery locations. North America, Western Europe, Australia, New Zealand, they're very high in cost, so that's why obviously not perceived to be very good in terms of cost. Now, what is interesting is if you take this picture, and you take all the other dimensions and you put them together, you get this complicated matrix here. But without making it too complicated, just if you look at the color scheme on the top, dark is good. Dark is a high rating. And now if you take India and you go from left to right, you will see that India rates really good or highly in basically every dimension except for one, which is customer centricity. And the same, more or less, with a little bit less color, is true for China. Also quite competitive on most things, but not so in customer centricity. So of course, many companies are headquartered in Western countries, so this is our perception of what they are good at. And we tend to think that Indians can do everything except for customer centricity. That just doesn't work. So, if you're selling India or delivering from India, that is the task, to fix that or improve that or to communicate that, because it might be a communication mistake also. And then equally, you could look at whatever other region on this overview and you'll find out interesting things. For example, Western Europe and North America obviously are really good at availability of digital skills in the middle. Now, if you look at North America, availability of digital skills is very good, and then left of it is workforce availability, which is empty. So it doesn't help me if the digital skills are great if nobody's available, right? And if you look at, for example, Latin America, on the right side, there is agility and innovation. So the perception is that there is no innovation going on in Latin America, which if I run a center from there and want to increase my scope is sort of a problem, because I'm not going to be able to attract any interesting work that requires innovation into that region. So as I said, this is not real data, it's a perception, so it can be changed. It's good if the data is better, because then you can work on it. And of course, there are things like Middle East and Africa on the bottom. I mean, this is kind of unfair to the region, because that's a huge region, and you could be looking at something like Egypt, which has a cost level 20% above India, so it's actually very competitive on that dimension. And you could be looking at something like Dubai, which is Western cost level. So I realize it's a very rough approximation, but I thought very interesting to see what the market perceives these regions to be.
Thanks, Tom. And I guess, that's the one element of all the benefits that will come from kind of working in different locations. But again, with everything, it comes down to, while there's plus points on the one side, actually running the process or multiple versions of the same process across different regions has its own challenges. One area is enough, but then start to impact that into different areas, and you start to build on that inefficiency around the processes. So you're kind of taking those manual processes and recreating them 3, 4, 5 different times in different areas. That then has an increase in the number of errors, especially where teams are changing, or availability of or quality of workforce differs across the regions that you're expanding into. That then naturally has an impact into the visibility piece that we talked to, and the communications, data and access to data, manual data, where you're trying to bring all that in together and consolidate it, is delayed. That makes it challenging to monitor status of the different areas, different regions, different processes in real time. That, from an AR perspective, then has the impact on financial reporting, and the close and the challenges of bringing that together can be complex, time intensive, and actually involve multiple reporting teams to do that, which has a natural cost financially and in effort itself. Then you're going to get data silos, because you've got things in spreadsheets, old files moving around, people not sharing everything they need to just because of time constraints or that they don't want to. We then see this commonly is that different areas will do the same process in the function of collecting debt, chasing debt, applying payments, but the way they go about it is incredibly inconsistent. So from an audit, from a looking at the process point of view, you'll get varying practices in different regions, different teams follow different processes, which leads to inconsistencies, and that can be across the piece, from billing, the collections processes or the strategies, communication with customers, and those customers may be in multiple regions as well, and so that you get different experiences depending on what region you are, even if it's coming from the same company. That then inherently leads to compliance challenges and risks, because each region then will work in a different way, and you'll trade with different regions. We're seeing this commonly in the invoicing piece now, where the different countries are changing mandates and the way they want their invoices regionally. And so if you're not on top of that, having that process in place, there's going to be an impact there as well. And then obviously the point that I made earlier, all that leads to customer dissatisfaction internally and externally. But actually what we're seeing from the technology point of view, if I change that, is that we can start to build and improve across all of that piece. You know, we've talked about the efficiency of just automating that process and reducing errors financially from misapplication or data keying errors that come with it. But then what you start to do and start to build by having that one source of data, and that's, you know, being fed from one to multiple ERPs, is that we start to get the view across the whole group as a whole. So we can use that data to improve operationally, and then, as I said earlier, about the strategic piece as well. But then we can start to build, you know, with FX rates and stuff, we can start to build consolidated views of reporting, you know, ultimately at the highest level for the whole entity, for the whole business, right down to the different business units. And all that's being processed automatically in the background by these technology platforms. That means that people, teams don't have to go and do it themselves, and then it becomes more available. It's ready when you want it, rather than when somebody's been able to process that for you. And what that drives then is consistent practices, so that you can start to define and have the platform control the process. That means that teams and people have to stick to those processes, so that you can start to introduce repeatability and scalability across any regions that you then want to go and expand into, because you have that defined process and a system that is policing that for you, if you like, so that you're not having to bring on new teams and get regional specialists to deal with certain areas. You can have everyone become a specialist across all the areas that you're working in. And then that's obviously going to give you benefits around the compliance piece and how you comply with local and more global regulations and tax laws. And again, going back to that e-invoicing piece of making sure that invoices are compliant and can be submitted, therefore not impacting that whole piece around getting payment for those invoices, and then the impact on the working capital as well. Because it's all transferred securely, you can be sure that the data is far more secure than, you know, files on emails that could go to the wrong person, files on shared drives that can get deleted because of shared access. All of that process is much more secure and more efficient than it is normally. And then inevitably that leads back to that whole point around customer satisfaction of teams get better data, teams get more reliable data, teams are engaged, and that ultimately then leads to better experiences for external customers as well. And ultimately on that, really, the piece that's left to talk about that we haven't kind of talked to so far, we've talked about it a lot, but not kind of addressed it directly, the people and the human element of the processes that we're all working in inside the shared services.
All right, so talent and technology are sort of two sides of the same coin. So if we cover automation and technology, we obviously need to cover talent and people to some extent also, because somebody needs to be setting up and using this technology. First of all, if you look at the size of centers nowadays, it's also kind of interesting. The median seems to be somewhere around 1,000. Most clients I know will tell me that once their centers become 1 or 2 or 3,000 FTEs, they tend to want to open a new one instead of growing it further, because the complexity of running a very large center can be quite high. There used to be a view that you needed to have a few hundred FTEs in a center for it to be efficient and effective. Nowadays, that limit has come down significantly, or the number of FTEs you need to set up a center is lower because technology is much more scalable. It's much easier to open up a center with 30, 50, 80 FTEs, and it can be fairly efficient. So it's not necessarily required to always have 300 FTE centers anymore. And you can see that the largest group of centers is actually below 250 FTEs. And another topic I wanted to highlight in context with people is this role called GPO, or Global Process Owner. And most people will have some sort of process ownership approach or view or dimension incorporated, but this is one of the tricky topics, really. If you do a piece of research and ask who's doing process ownership or who has a GPO role installed, then most people will say we do. And then if you ask a question about the results of that, they're very, very low. And the issue is not that the concept doesn't work, it's just a little bit tricky to implement, and it requires a lot of good implementation. We're not going to go into that in detail, but there is sort of a resurgence of this lever, because GPOs can be a very good lever for you to improve that transformation journey, or that journey up the value chain that we're all trying to get on, but often have difficulty getting further with. And what I realized looking at all these GPO materials is that most slides that you will see always just have 3, 4, 5 processes on it. So you will see a GPO for order to cash, purchase to pay, record to report, then maybe something out of HR, and then that's it. And this slide is sorted by function. So you see first finance and HR, then procurement and so on. That's why the numbers jump back and forth. But the logic of it is that it doesn't apply only for finance. So while most people here will be finance, great, but this would also apply to all areas of finance and other functions. And that's why I wanted to highlight that most companies now have started, at least, to look into other functions too. And if the concept works in finance, then why wouldn't it work in HR, procurement, and so on? And then in terms of order to cash specifically, you could look at different sort of concept types. So there are different types of GPO setups. And on the top, we have a designated order to cash owner who is accountable for the end-to-end process, which of course we all think is sort of the final target or goal of this. But what happens in reality actually is that often you move towards that setup in steps. So the next 3 options are where we have separate or multiple owners for sub-processes, and they have some level of coordination, high level, low level, moderate level of coordination. And often there are process owners or SMEs for the sub-processes we have looked at, and then some sort of network communication between them or coordination between them is installed. And over time that becomes more structured, until then finally there's one designated order to cash process owner. There's nothing wrong with that process. It's actually a very good way to get there. But it is the target, of course, to get to that upper designated end-to-end order to cash owner, because the whole point of having a process owner is to install the end-to-end process view in an organization which typically follows more a functional or siloed view. And then in terms of talent, just a few points on that. I mean, we all know that we're in this really difficult labor market situation where somehow it's hard to find anybody out there. There seems to be, in my view, sort of almost 1 billion people in Europe and North America, but somehow nobody's available. And therefore, it is really an employees' labor market currently, and employers have to invest a bit more. So it's important to understand what the employees are looking for. And this one I thought is interesting because in the middle, at 44%, we see increased compensation and benefits. And most of people who are older like me are used to a world where it was mostly about how much you would make in that job, or at least that was top of the list. Other things were important, of course, but that was always quite far on the top of the list. Now it's in 5th place, which I find sort of exhibits nicely how younger people, because GBS is mostly younger people, view this nowadays. You see in the second place is leveraging the company brand. So I keep telling clients, and I produced a research piece recently on branding, because I think branding in GBS is underutilized. You could do way more. Of course, it's all about the actual operational performance, but there's nothing wrong with communicating how good it is actually working. And then there are things like at 47%, selling the purpose-led vision of the company culture. We all know younger folks nowadays need a purpose. And this is easy to put this up here on the slide, but the trick is, how do you get from the accounting or transactional activity that somebody is doing or asked to do to the actual purpose or the actual benefit at the end of that business operation? And there are some really good examples out there. So for example, if you're a medical company, you could align the activity, maybe not easily, but somehow, with actually saving lives or actually improving somebody's health or things like that. And if employees understand how they are contributing to those targets and to those purposes, then their excitement or their willingness to stay in that job is significantly higher. And even if you do a really good job, you're still faced with this problem. They will still leave you after 1 to 3 years. So that's a sort of frustrating experience that most people are having, that they invest more and more, but still the fluctuation gets higher and higher, and the term that people want to stay with an employer is shorter and shorter. And ultimately, it just means that while you need to do all the things on the previous slide, you also need to come back to this topic called training and be able to train people better and faster and upskill and reskill, so that you can compensate for this movement, because there's going to be some amount of fluctuation that you simply cannot avoid. And I'm going to go through these really quickly because of time, but there's some overview here on how companies source or maintain their skills. So obviously internal training, as I highlighted, is on top of this list, but you could also use coaching and mentoring approaches, very popular. Of course, large organizations do that more than smaller ones. And what I found very useful are the ones in the middle, job rotation, both within GBS and also with the larger enterprise. And if you send people to the larger enterprise, you also install sort of ambassadors or multipliers who are all in favor of the GBS idea. So it makes your life easier in the long run. And in terms of the reskilling and upskilling on the bottom, you see how many companies are using what kind of approach. Ultimately, on this training front, it all comes down to using all kinds of different approaches together. There's not one silver bullet, if you want. And in terms of the skills that are being sought after in the market currently, I'm not going to go through everything on this list, but there's a few things I would highlight. So in the middle, for example, you see automation skills. In 2022, that was at 58%. Everybody was looking for automation skills, and now it has dropped somewhat to 39%. That means there's still a gap. There's still a lot of demand for automation skills, and it's logical because we need to move further on this transformation journey. But there's more supply, which makes this gap get smaller. And then the other thing I would highlight on this slide is that I think you can teach almost everything on this slide to people except for one thing, which is empathy, on fairly much on the bottom of the slide, 9%. But empathy is very useful in GBS organizations, probably more than 9%. And that is something which is very hard to teach to people. At least I was never successful in teaching anything like that. But everything else, whether it's accounting skills or languages or whatever, you can teach. But that would be the requirement I would give to HR or recruiting people who are working in cooperation with GBS to find the right individuals. And then in terms of this famous transformation journey, obviously this is not a research picture, but just rather a sort of funny joke. But I got this from a client some years ago, and they said the issue with their transformation journey really is that it's a bit like a caterpillar becoming a butterfly. And then you get on this journey, and then you're in the middle of this picture here, and you're you're not really a caterpillar anymore, nor a butterfly, just hanging there in the cocoon. And then you get stuck. And that's a really bad place to be. So if you get on this journey, you really have to get done with it. And then, as you know, transformation, if you have studied biology or you had old Greek in school, you know it means metamorphosis. And there's another picture on this slide, which I think is the bigger problem, that people mistakenly think that transformation is some sort of small change approach. But what it really is about, of course, is caterpillars becoming butterflies. But what people think it is on the bottom of this is just making this caterpillar really fast. And of course, that is not really what we are targeting to do.
Cheers, Tom. Just conscious of kind of time. So, hopefully from what we've been through, you've been able to see the view of the data in the industry and where things are going and what can be advanced. There's a shopping list of benefits to automation, but after 30 years of shared services and GBS, the automation rates of maturity is still not very high. Companies tend to focus on costs in short-term crisis, but actually what they should be looking at is more towards the longer term value and what can be gained rather than just that financial benefit. Looking at things like Tom said, the location logic has changed. So after 30 years of trying to bring everything together, now there's a risk reduction by spreading some of that or enlarging that geo footprint, but using tech to control and standardize and bring visibility across that process. So alongside that, hopefully we've shown you how that digital platform offers the chance to transform what you do today and go further in achieving that operational excellence and to give you that strategic data to allow you to move forward in the businesses and the shared services that you're working in and for. And at that point, I'll hand back over to Susie.
That's great. Thanks so much, Danny. Thanks, Tom. So questions coming through. We've got a couple of minutes for questions. And meanwhile, we've got a poll up on the screen now. So what would you like to do next? Would you like to hear from Danny and his team, maybe have a demo with Danny, or receive more information about the Blackline solution? So kicking off with questions while I leave that poll open. What's your recommendation? And I'll put this one to Tom. What's your recommendation of a GBS data strategy, Tom?
That's a broad question. I don't think I can cover that in 3 minutes, but of course we know all these statements about data is the oil of today and all of these things. The target really is not the data itself. The target is that we have this topic called analytics, which we really need to improve. And to be able to do anything on the analytics front, we need good data. And without that data, and so more or less holistic, complete, error-free data in a sorted manner, we can't really do all that analytics work and can't move up the value chain and can't support the core business. So therefore, I would start by looking at, have I done my basic homework with having master data in GBS? And if not, start with that, get that in a scope and sort it. And then comes all the technology bit that then Danny can answer how he would do that if he wants.
Danny, anything to add to that?
I think for me, the point is with every strategy, just make sure there's that focus on standardization and controlling it really. So to Tom's point there of making sure that it's valuable, you need to make sure you're managing and looking at the right data to drive and generate kind of the right metrics that come out of it. So tech is good, but it's about that, you can process all the data you want, but actually what is it that you want to get out of it and benefit from? That's the real focus, rather than just we want everything. Actually, what's going to give you the advantage, if you like, or the ability to move forward. I think that's what I'd keep in mind when looking at it.
Okay, good. Is there any VAT management capability within the Blackline solution?
Without knowing exactly what element, yes. So Blackline kind of look after the AR side of things, but ultimately we have the wider platform as well. And so we find that, if it's not a specific kind of thing to AR, typically what we find is that customers can use the close side of things and the transaction matching and the process within that to do it. So I would just say whoever that is, we can follow up and kind of understand that challenge and work it out from there.
Okay, good. We're going to leave it there in the interest of time. So to Tom and to Danny, thanks so much. And to all of our listeners, thanks for attending today, and we look forward to welcoming you next time. Thanks so much and goodbye.